This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Warning sign, the U.S. economy got some disheartening news about one of its most important sectors. We'll put it in perspective for you.
Financials fumble, why bank stocks here and across the globe are getting beaten and bruised in 2016.
Protect your portfolio, the mutual funds that may protect your money in a volatile market like this one. All that and more tonight on Nightly Business Report for Wednesday, February 3rd.
Good evening, everyone, and welcome. Do not underestimate the power of crude, at least not in this market. Stocks staged a massive comeback just as the price of oil surged. That relationship between stocks and oil is so strong, it shrugged off an unexpectedly weak services report, which pressured equities early on and sent bond yields sinking. We'll have more on that momentarily. By the close, the blue chip index gained 183 points to 16,336, moving about 400 points from its low to its high. The Nasdaq slipped 12 and the S&P 500 rose 9. As for domestic crude prices, take a look at that percentage gain, 8% to the upside, snapping a two-day rout as the dollar tumbled and despite record inventories. If anything, today was a reminder of why this market is anything but boring. Bob Pisani explains what fueled today's rebound.
We stopped dropping when oil stopped dropping about 11 a.m. Stocks went sideways until about 2 p.m. when the whole market turned around. The Dow rallied over 250 points in about an hour. Oil also rallied to the highs for the day. So what happened? Well, some are citing vague rumors that oil-producing countries are trying to cobble together an agreement to limit production. But, we've heard those rumors before. Regardless, beaten-up sectors like bank stocks finally rallied. Some of these regional banks are down 15 to 20% this year. They don't have any international exposure, and most do not have huge exposure to energy loans. So why are they selling off so dramatically? I get that there's concerns that low rates will hurt banks, but most traders feel the extent of the sell-off makes no fundamental sense. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
More now on that sobering economic news. The services sector, which accounts for about 80% of U.S. economic activity, is starting to cool. And as Steve Leisman explains, that's exactly what economists don't want to see.
A key economic report that bulls hoped would show the U.S. economy holding up instead weakened unexpectedly. It was the third straight monthly decline for the much-followed service sector survey from the Institute for Supply Management. It's now dropped to its lowest level in 2 years as the outlook for services employment and new orders also declined. The measure still shows growth in the economy and growth in services, but the weakness suggests that troubles elsewhere in the economy, from manufacturing, a strong dollar, a declining energy industry, and weak overseas growth, are now spilling over to the service sector, which is the biggest part of the U.S. economy.
We learned today that the service sector is following the manufacturing sector lower in traditional lagged form. This means that the broader economy is likely slowing as measured by real GDP growth.
As a result, Livornia upped its chance of a U.S. recession to 40% from around 33%, despite a separate ADP report suggesting strong job gains in excess of 200,000 in January. Others on Wall Street were more inclined towards Livornia's pessimism.
The global environment is very much part of the recessionary risks that the U.S. faces. It's about importing those risks from an external shock, and the manner in which that occurs is through financial market conditions.
In addition to ignoring the stronger than expected ADP report, there was also little focus on dovish comments from the New York Fed president. Bill Dudley said in an interview that a stronger dollar and a weaker global economy could have, quote, significant consequences for the U.S. economy, and that financial conditions are tighter now than they were when the Fed last met in December, and the Fed has to take those tighter conditions into account when making monetary policy. Most of the data this week has been soft, but there's one more chance for the bulls. If the actual payroll report on Friday shows strength, along with wage gains, it could direct the market away from fear of recession and back to the upside of cheaper oil and more Americans being employed and bringing home paychecks. For Nightly Business Report, I'm Steve Leisman.
Michael Hansen joins us now to talk more about the economy. He is senior economist with Bank of America Global Research. Michael, welcome. Nice to have you here. Let's start with that recession call. Joe Livornia, 40%. Others are right around there, but you think that the percentage would be quite a bit lower than that. Why?
Yeah, we've been saying that it's probably in the vicinity maybe of 20%. I do think the risks are perhaps skewed towards it being higher if we continue to see a sell-off in the markets. But right now, it still looks like the fundamentals of the economy are not as weak as the markets might suggest. And as one of your earlier stories suggested, there does appear to be a bit of a disconnect there. The labor market continues to be strong. We'll obviously see if that continues on Friday. Consumer fundamentals are fairly good. The housing market is still doing well. We actually have a little bit of a fiscal stimulus in place for this year as opposed to the drag we've had the last couple of years. So there's a number of things that are going the right way. And it really does, I think, come down to whether the service sector can hang in there. It is a much larger share of the economy. We saw a little lost momentum today, but not a deterioration. Whereas the strong dollar has really pulled back manufacturing, and that is certainly something we're keeping an eye on.
Michael, do you see the economy slowing from its fourth quarter pace? And it doesn't have much farther to slow. It was like, what, 0.7% growth, or picking up steam here in the first half of the year?
Yeah, picking up steam might be a little strong, but I think we do get a rebound. I don't think 0.7 is the likely trend in the near or longer term for the economy. I would say that we're probably going to see something in the vicinity of around 2% growth this year, give or take. I think the underlying trend is a little softer than that. So if we run above trend, we should still continue to see job gains and a little bit lower unemployment rate as well.
What about the dollar? That has been, certainly today, it had a dramatic move, but overall it has been higher and stronger for a lot longer than everybody thought. Is that what's really hurting the manufacturing and services sector?
I think it's hurting manufacturing more than it's hurting services by a notable margin. Most services are produced and consumed domestically, and so they're not exposed to the dollar. But there's a significant portion of manufacturing that is, and I think that really has been a significant shock. You're up some 20 to 25% now in the trade-weighted dollar in the last year and a half. That's one of the larger moves we've seen in quite some time, and I do think it's having a meaningful adverse impact on the industrial sector.
All right, Michael, we'll leave it there. Thanks so much for joining us. Michael Hansen with Bank of America Global Research.
As concerns about the economy grow, bank stocks have been beaten and bruised. And how? The financial sector is the worst performing group this year so far, down almost 12%. And it's not just U.S. bank stocks, but European ones as well. Kayla Tausche explains why.
2016 was supposed to be a banner year for the banks, but a weak economy has been putting even more pressure on the industry. Fears of an economic slowdown based on market drops overseas and negative data we got on the services sector here in the U.S. drove investors into treasuries, pushing prices up and yields down. The yield on the 10-year treasury fell to its lowest point in a year. Now, that has a negative effect on the banks because that's the benchmark for mortgages and other fixed-rate loans. So while low yields might be great for consumers, they hurt bank profits and therefore bank stocks. If the slowdown does cause the Fed to hold off on more rate hikes, another potential benefit for the banks, that's going to hurt too. And then the icing on the cake, the fear that more energy loans could go bad. For all of those reasons, Paul Miller of FBR said it might take a while for investors to jump back in.
You got to get the 10-year to stabilize. You got to get energy prices to stabilize, I think, before anybody really comes in. If you have a long-term view, you can buy some of these things today and make a lot of money here. But right now, nobody wants to own these things.
In Europe, the problems are far worse. The Euro Stoxx 600 Banks Index down 23% this year as the lengthening recession makes more loans go bad. Italy, for instance, has 350 billion euros in bad loans. They're now offloading to private investors with government backing. In Spain, the Bank of Spain said bad loans fell to 10.3% of total credit in November, but that risk has the stocks of Santander, BBVA, all falling. The fear is there's more where that came from, and the earnings have not been reassuring to that end. Deutsche Bank has seen its market cap halved in the last year, and it's warned it'd see more than $7 billion in losses in 2015. Government-owned RBS said it'll post a loss too and pay more than $2 billion in a mortgage settlement with the U.S. Standard Chartered plans to lay off 15,000 employees in the next 3 years. So these deep restructurings, these bad headlines, it's familiar to U.S. investors because we went through it after the financial crisis. But right now it's hard for investors on both sides of the Atlantic to see a light at the end of the tunnel. For Nightly Business Report, I'm Kayla Tausche in New York.
Growth in China has been an overarching concern for investors, and today the Chinese government said the world's second largest economy would expand between 6.5% and 7% this year. The new target comes as policymakers in that country battle the slowest growth in 25 years. Beijing will also try to curb overcapacity, and that could increase unemployment in areas with a high output of steel and coal.
A Chinese company is making its biggest foreign acquisition yet. The China National Chemical Corporation, known as ChemChina, will buy the Swiss seed company Syngenta for $43 billion in cash. According to DealLogic, it's the most expensive agricultural transaction ever. The deal will help China expand its food production, but it may raise regulatory concerns here, since Syngenta owns U.S. chemical facilities.
The Chinese slowdown has been hitting some U.S. multinational companies very hard. But for many American retailers, it hasn't been all that bad. And as Courtney Reagan reports, these companies are invested in China for the long haul.
For decades, China was synonymous with outsized growth, offering investors and companies a new market to penetrate. But as fears of a worsening China slowdown weigh heavily on industrial and commodity-based companies, retailers look at China differently, and growth is still a large part of that view.
China could ebb and flow, and there are different considerations with GDP growth in China, the housing market, and different economic considerations. But as far as retail goes, in terms of luxury goods and global brands, it's a very important market for the long term. So retailers can't really ignore this market and need to continue to invest in it and also build their awareness and their brand and their identity globally.
On a conference call, Bernard Arnault, CEO of luxury conglomerate LVMH, acknowledged the economic slowdown in China, but also said, quote, many observers underestimate the fundamentals of China's economy, noting household consumption is on the rise there. Like other retailers, the luxury goods seller looks to the country as a long-term growth driver. PVH Corp just announced it will buy the remaining interest in its Tommy Hilfiger joint venture in China. CEO Manny Chirico says China is the fastest growing market for Calvin Klein and Tommy Hilfiger. Michael Kors and Coach just reported double-digit comparable store sales growth in China, while noting weakness in Hong Kong and Macau. Retail experts with an eye on China say the higher-end consumers' penchant to spend may be leveling off, as evidenced by weakness in travel to Hong Kong and Macau. But spending in mainland China remains healthy, which is where retailers are concentrating their investments in the country.
We've been seeing somewhat of a global pause in Chinese traveling, so that's something we watch out for at names like Tiffany, Richemont, and higher-end names.
But mid-tier retailer H&M says it is, quote, very happy with business in China, even in a tougher environment. H&M and Victoria's Secret parent company L Brands plan to add stores in China this year. However, retailers that don't operate in China, like Macy's, are seeing a drag from China's economic slowdown. Fewer Chinese tourists are traveling to the U.S., which means less spending at its flagship stores in big cities. And China has proven lately to be unpredictable. So if the slowdown leads Chinese consumers to pull back their spending, it could be trouble for retail. For Nightly Business Report, I'm Courtney Reagan.
Still ahead, mutual funds that may help you stay calm in a stomach-churning market. Sumner Redstone has resigned as chairman of CBS. CEO Leslie Moonves will assume the title of chairman and replace the 92-year-old. A lawsuit challenging Redstone's mental competence had raised questions about whether he should continue in that role. Shares of CBS rose in initial after-hours trading, as did shares of Viacom, where he is also chairman. Viacom's board will reportedly meet tomorrow.
GoPro swings to a fourth quarter loss and issues a disappointing revenue forecast. The action camera maker lost 8 cents a share. Analysts were looking for a break-even quarter. Revenue also fell short at $437 million. That's a decline of 31% from a year ago. The results sent shares lower after initially rising in after-hours trading. But as Josh Lipton reports, the real focus is on whether the company has a strategy to be more than just a camera maker.
GoPro was a Wall Street darling when the company went public in the summer of 2014. Investors bid up the stock to nearly $100 that fall, but since then it has suffered a wild ride, just like one of the company's famous action-packed videos. GoPro's big mistake? Last year it introduced its newest camera, the Hero 4 Session. GoPro billed the camera as its smallest and lightest camera to date, but the company grossly mispriced the product. The original price of $400 was slashed twice down to $200. On top of that, GoPro's CEO Nick Woodman says the company made a mistake by not dedicating enough resources to its marketing efforts. Added up, and GoPro suffered a disappointing holiday season, leading to layoffs at the company and a stock that dropped to $10. So what can Woodman do now to turn around this company? Analysts say it starts with a new camera that needs to boast exciting, innovative features.
There's a number of cameras we're seeing that are starting to come out. Nikon had one that they announced at CES that can capture in 360 degrees. So the idea is a GoPro camera today captures 180 degrees, but you'd love to be able to get the full sphere around you. And that would be something that you could use that video in like a VR headset, so you could pan around and see that video from all sides. You could share it on social media. People could pan around that 360-degree video. I think that's where these cameras are headed in the future.
Analysts say GoPro also has to upgrade its software, making it easier for users to edit and share content. There are also new products on the way that need to be a hit.
First out of the gate would be the drone that they're calling Karma. That's supposed to debut in the first half of 2016. So it would be their first effort in a quadcopter drone. It's a big market already. DJI is the market leader. It's over $1 billion. They are a popular holiday gift. So, you know, GoPro is the brand. They have the distribution. A lot of the drones that people have used historically use a GoPro camera built, you know, that they attach into it. So they already have some mind share in the category. So as long as they get that product right, I think they will have an audience.
Even bulls like Anderson, though, say it's fair to ask whether it's just too little, too late for GoPro. After such a tough year, winning back credibility with investors won't be easy, but the start of a rebound, if there's going to be one, begins now. For Nightly Business Report, I'm Josh Lipton in San Francisco.
The pharmaceutical giant Merck misses its revenue target, and that is where we begin tonight's market focus. The company said a strong dollar and increased pricing pressure cut into sales. Fourth quarter profit at the drug maker fell nearly 90% compared with the year before, when it had a big gain from the sale of its consumer health business. Merck also issued a cautious 2016 outlook. The company's shares fell fractionally today to $50.05. Similar story at the snack company Mondelez. It saw its shares fall after a 17% drop in quarterly revenue, partly because of the dollar and the sale of a majority of its coffee business. The Oreo cookie maker was also hurt by a nearly $800 million accounting charge related to its Venezuela unit. Guess they don't eat Oreos down there. Shares of Mondelez fell 6.5% to $39.23. General Motors benefited from strong results in the U.S. and China and rode them to a record profit in 2015, nearly $10 billion. The nation's biggest automaker also reiterated its upbeat earnings outlook for 2016. But despite the news, shares fell 2.5% today to $28.92. And the shares of the battery manufacturer Energizer Holdings kept going and going today after the company saw an increase in earnings and revenue that topped Wall Street estimates. The company attributed its growth to strong sales and increased prices, and it raised its full-year guidance. Shares surged nearly 17% to $36.86.
Activist investor Starboard Value has taken a nearly 7% stake in Marvell Technology Group, saying the chipmaker's shares are undervalued. Marvell has lost over 40% of its value since last year, following the September announcement of an internal accounting investigation. Marvell shares rose about 7% to $9.27. Fourth quarter profit at oil refiner Marathon Petroleum Corporation fell nearly 80%, but that was still good enough to beat street estimates. Revenue at the independent oil refiner fell by almost 30%, and that was well short of expectations. The company said it plans to cut capital spending for 2016. Shares of Marathon fell more than 7% to $37.20. Insurance giant MetLife missed forecasts on both its top and bottom line. The company blamed a drop in operating earnings on a strong dollar and a decline in investment income. Shares initially dropped in extended hours, adding to the 1% loss today, in which they closed at $41.95.
Well, it's been a bumpy ride for the U.S. stock market so far this year. Don't need to remind you of that. And also, though, for the mutual funds that invest in U.S. companies. And if the downdrafts have you wondering whether you're in the right mutual funds, we've got some possible solutions for you. Funds that participate in rising markets but lose less than most when stocks swoon. Joining us now to discuss is Christine Benz, Director of Personal Finance at Morningstar. Christine, always good to see you. Welcome back.
Tyler, good to see you.
You know, it has been a down year. The S&P 500 off, what, about 6.5% or thereabouts. How's the average U.S. stock market doing, and are any of them making money so far this year?
Just a tiny handful of funds have made money, and most of them are using odd strategies. So I would say if you're looking for funds that have made money, you generally don't want to hold them as core positions within your portfolio. What you want to look for are mutual funds, if you're in the equity market, mutual funds that have lost less.
So make me feel better or worse. What's the average fund down so far this year? US
About
stock.
7% through yesterday.
And you know, I'm noticing these are some of the equity funds in the green year to date, but I'm looking at the returns, and those returns, many of them don't even equal 1%. I think the Federated Strategic Value Dividend Class A is the top, and that's just over 2%. So even those who are in the green, the results are not all that impressive compared to previous years.
That's right. And you might find some funds that are using inverse strategies. Those are up, but they'll also tend to be way, way down when equities are up. So you generally don't want them in your portfolio.
So you gave us a list of 3 funds that can provide some protection in this market. They'll lose less than the averages when the market goes down. They may make less than the average when the market goes up. But tell me about number 1, American Century Equity Income. Why do you like it?
This is just kind of a classic equity income fund. It's dividend focused. One thing that it does a little bit differently from some other dividend focused funds is that it typically holds some convertible stock as well as some preferred stock. And that does 2 things. It bumps up the income cushion a little bit, and it also tends to, that piece of the portfolio tends to behave a little bit better when equities are going down. So it has a very long tenured management team. They've been doing this same strategy for a number of years. They tend to focus on the defensive industries like healthcare, consumer defensive, and utilities.
Next on the list, the Jensen Quality Growth. You say it is a tame, large growth fund.
Right. We often think of the large growth category as being kind of an aggressive category. This is not an aggressive fund. It uses a pretty formulaic strategy in that it focuses on companies that have returns on equity of 15% or more over the past 10 years. That tends to give it a basket of highly profitable, highly stable companies. It's been a good performer in weak markets, including so far in 2016.
And a quick thought on Vanguard Dividend Growth, Christine.
This fund would actually be at the top of my list among defensive funds that I would recommend. It's a sturdy fund. It uses a quality-conscious strategy, so its yield will not be high in absolute terms. It'll be kind of right in line with the S&P 500, but it will be a quality basket of holdings, also very low costs like any Vanguard fund.
And a manager who's been there for a long time.
He has, Don Kilbride from Wellington Management.
All right, Christine, thank you very much. Christine Benz with Morningstar.
Coming up, why this weekend's big game means big business for one small store. A tough day for shares of Buffalo Wild Wings. The restaurant chain's quarterly results fell short of Wall Street estimates. Same-store sales also declined, and food safety concerns hit one of its restaurants in Kansas. Shares fell more than 4% in the regular session and extended those losses initially in after-hours trading.
But this, folks, is a big time of year for chicken wings, especially for small business owners who rely on strong sales during the big game this weekend. Kate Rogers reports from Belmore, New York.
The competition will be fierce on the field and in the kitchen this Super Bowl 50 weekend. And it's not just the teams that have something to prove.
The one goal we're looking to break this year is our hourly volume to surpass 4,000, which we missed it by like $50 last year during 1 hour. We did about 3,900.
Wing Zone franchisee Matthew Licht is out to top last year's sales of nearly 50,000 wings on Super Bowl Sunday alone. It's the calm before the storm right now, but all hands are on deck at the store come this weekend. Everyone from his dad, Steve, who's co-owner, to his wife, Marissa, who's 8 months pregnant, will be working. So far, he has just under $11,000 in pre-orders between his 2 stores on Long Island. This year, Americans are set to eat 1.3 billion chicken wings on Super Bowl weekend, which is big business for fast casual restaurants. Last year, national chain Buffalo Wild Wings sold more than 11 million wings on that weekend alone.
The growth in the restaurant industry in franchising is really across the board, both from quick service restaurants to full service restaurants, and really that fast casual area that sort of cuts in between both.
The challenge for small businesses like Lick's is ordering the right amount to keep up with demand. WingZone already has 4,000 pounds of wings in the cooler, but they had to learn the hard way a decade ago.
Our first year, no one knew what to expect. The day just was crazy. People waiting hours. We had to cancel a lot of orders. It was the closest thing to an epic failure that you can think of.
WingZone took out an ad in the local paper to apologize to customers, and sales jumped the next year. They've continued to climb every year since. Just like the players on the field, Licht is hoping his prep pays off. For Nightly Business Report in Belmore, New York, I'm Kate Rogers.
11 million wings?
Yeah, and more than 1 billion during the game. Who's going to count all those wings?
I don't know.
I don't know.
That does it for us tonight. Thanks for joining us. I'm Sue Herrera.
And I'm Tyler Mathisen. Thanks for me as well. Have a great evening, everybody, and we'll see you back here tomorrow night. Bring the wings.
Bring the wings, exactly, and the hot sauce.